In terms of major economic trends over the first half of 2018, it's really been a continuation of this global synchronised economic growth that we've seen since mid-2016. And largely that's been across the advanced economies. Some of the sheen is coming off that a little bit at the start of 2018, largely in Europe. But most importantly, the US economy, the largest economy in the globe, has continued to grow well. Part of that's been the boost through tax cuts that we've seen and fiscal stimulus going into that economy. So looking out over the next 6 months, and of course it's very difficult to kind of crystal ball gaze over such a short period of time, but I think the two sort of major known unknowns, if you like, out there are how fast is the US Federal Reserve going to increase interest rates, and also on the same token, how fast is inflation going to come back in the US economy, and what flow-on effects that might mean for asset prices. And also, are we going to see, if you like, further steps or escalation in this trade war or potential trade war between the US and a number of its trading partners? So if we look at the interest rate picture in the Australian market at the moment, we're a bit different to the US, where they are well into their interest rate hiking cycle at present, whereas we haven't started ours, and perhaps we won't start ours until the second half, or maybe even after that in 2019. Part of the reason for that is that we still do have quite low wages growth, and that retail prices generally have been relatively subdued to date. It's true that at a national level we've seen residential property prices slow over the last year, and predominantly this has been across the Sydney and Melbourne property markets, where price growth of around about 10 to 15% has now slowed to basically flat price growth, or in fact in the Sydney market, property prices are down about 5%. If we look at some of the other major capitals, price growth in Perth has been negative for a while now, although it's starting to become, if you like, a little bit less negative. Then if we look at Brisbane and Adelaide markets, their positive price growth has started to slow a little bit as well. There's a few factors that have been driving this. One has been, if you like, high supply for really 2 years now in the Australian market, and slowing demand across a number of different factors. So part of it's through slow loans growth, both to investors and interest-only borrowers. Part of it's also been higher wholesale funding costs from the banks that some of them have passed on to borrowers. And part of it's just been a general tightening in lending criteria. So currently price growth is fairly flat at a national level. Wouldn't be surprised to see at a national level property prices maybe go down around about 5%, say over the next 12 months. This would be a similar decline to what we saw during the GFC in 2008, 2009, and also drops that we saw really around 2011 and 2012. One of the differences this time though is it's very unlikely that the Reserve Bank in Australia is going to cut interest rates further from here, which is really what spurred property prices to re-accelerate in those two other periods. If investors do have a long-term goal that they're funding, a key example being retirement, then they do have a greater capacity to weather the ups and downs of riskier asset classes that tend to be more volatile in the short and medium term, a key example here being the share market. But if you actually look out over longer periods of time, the share market tends to not be as volatile, and you also tend to be rewarded, if you like, for taking the risk or that extra volatility that you do tend to suffer from time to time in the short term.